Welcome to the Alternative Investments Conference YouTube channel. We are joined today by members of the firm Dechert LLP. Dechert is a leading global law firm with 24 offices around the world and approximately 1,000 lawyers across 12 countries. The firm advises 300 plus private equity and private investment firm clients in evaluating, structuring, and negotiating private equity transactions, and has been an active advisor in the industry for over 35 years. The firm has also been a proud sponsor of LSE's Alternative Investments Conference for a number of years. In today's presentation, I welcome Mark Evans, Samantha Koplik, and Zach Oswald from Dechert to discuss 2021 and beyond, the private equity outlook for 2022. Here with us at AIC today are three members of the firm. I'll allow them to introduce themselves.
Hi, I'm Mark Evans. I'm a partner in the corporate group in Dechert's London office. I focus principally on private equity, alternative capital providers, restructuring, and public M&A.
Hi, I'm Sam Koplik. I am a partner in the New York office. My practice focuses mostly on acquisition financing and other financing matters for our PE clients, but I also do a bit of public company work and a bit of restructuring work, and I'm delighted to be here today.
Hi, everyone. I'm Zach Oswald. I'm a member of the financial services group in Singapore. I represent sponsors of private equity, real estate, and credit funds in connection with their formation, management, and ongoing fundraising. I'll actually kick off the discussion on the things that we've seen, what the market looked like in 2020, and what some trends we're seeing in 2021 and what we expect to continue into the future. So to begin with, 2020 overall was a pretty moderate year. I think most people would have expected, given the pandemic, that the amount of capital raised would have dropped significantly as compared to earlier years. But as you can see on the chart and following the thin line, the amount raised in 2020 was just below the average over the past 5 years or so. But as compared to the past 2 decades, it's significantly up in a pretty solid year. So part of the reason for the decline is that in the first part of 2020, predominantly March through June, there were a number of funds that put their fundraising efforts on hold or put a temporary pause. A number of investors were looking at what their asset allocations and investments looked like and weren't eager to commit any significant amounts of capital in that part of the year until the markets, the public equity markets settled down a little bit and everyone got a better view of what the remainder of the pandemic might look like. So overall, I think people are pretty satisfied with the big picture number. But if you peel back the data a little bit, you'll see that 2020 was a year much like or in the fund formation space was much like it was in the rest of the market, which is really a K-shaped recovery, right? So we have a lot of haves and have-nots, where the ones that are doing well are doing really well, and the ones that are not doing well at all. So who are the big winners from the fund formation market in 2020? It's predominantly the large, well-known institutional private equity sponsors that also raise other multi-strategy funds. And the reason for this, and one of the main reasons, is that if you're a fund sponsor that has the institutional capabilities and bandwidth to be able to switch strategies quickly, they were able to take advantage of the market dislocation caused by the pandemic. So there are examples of funds that were raised specifically to invest in distressed companies or others that had lost revenue or closures as a result of the COVID crisis. And as a result, these fund sponsors were able to raise money specifically targeted for those strategies. Whereas other kind of single strategy sponsors that have a narrower focus weren't able to quickly pivot, and they were the ones that had to put their fundraisings on hold. Another reason that these large institutional sponsors were really doing well in the fundraise, or despite the pandemic, is that some of them have just great reputations in the market, and investors were able to come to them without doing any face-to-face interactions or any face-to-face meetings, which was difficult, obviously, given the lockdowns and travel restrictions. So the market knew who they were, and investors were able to invest regardless of the level of due diligence. And the third kind of related reason that I'll touch on a little bit more in a bit is that there's been a trend for a number of years where investors are consolidating their relationships with certain institutions. So those investors that have existing relationships with the fund sponsors were able to make commitments to their funds and do so without kind of fresh sets of diligence. So when you compare that to the smaller single strategy sponsors, emerging market or emerging sponsors who don't have that same relationship with an existing investor base, they really weren't able to capitalize and they struggled. So that represents a large reason why the overall market and capital raised was down, but not as much as you maybe would have thought. So that's kind of just the big picture overview of what fund formation looked like in 2020. If we go to the next slide, I'll start to talk about one of the first trends that we're seeing in the fund formation space. And this is a trend that started a number of years ago, really in the 2008-2009 financial crisis. And this is a trend of fund sponsors raising different strategies. So as I mentioned earlier, if there's a private equity sponsor, but they raise a distressed investment fund to take advantage of the COVID crisis, or if there's one that wants to raise a venture capital fund on the side or a real estate fund, these are the diversifications that we're talking about. And the one that happened after the 2008-2009 financial crisis that started to boom was the private equity fund sponsors raising credit funds. So these are funds that make loans to private companies. And for the most part, this is to fill the gap that happened as a result of the retrenchment from banks after the financial crisis. So a lot of private equity sponsors realize that when they're investing in companies, they do a lot of due diligence and research on the particular companies with making the equity investments. And a lot of that is useful for making loans as well. So one company might have an equity investment from a private equity fund, and they may borrow from a credit fund that are both raised by the same sponsor. So that was the biggest trend of diversification and has been for the past maybe 10 years. If you see on the chart, and I won't go through all the details, but private debt and direct lending strategies, 23% of respondents in the survey said that this is what they're thinking about diversifying into. So again, private equity moving to credit is still one of the most popular. The other one that is the kind of flavor of the month that we've seen a lot of fund sponsors raise and on the side and branch out into the new strategies are impact investing. And this is related to environmental, social, and governance. So it's actually back on the last slide. You can see that again, 23% of respondents said these are the types of investment strategies that these fund sponsors are considering branching into. So when we're talking about the social good and the socially conscious investments, it's something you'll see in the news a lot right now, that investors want to know that their investments are doing good as well as having profitable returns. And then one that's not mentioned on the slide, but we'll touch on briefly because, as you might expect, it's been getting a lot of press lately, is funds that are looking to invest in cryptocurrencies and blockchain technology. Those have been very popular in the past few months in particular. And so we're seeing more and more traditional private equity sponsors branch out into those areas. And so on the next slide, and it's the last trend that I'll talk about on the private equity fund formation space, is again, with all of these investors demanding that particular private equity sponsors come up with strategies tailored to their needs, it all kind of fits together in the fact that the larger institutions are able to raise more in different strategy funds, investors are also going to those sponsors and asking for or demanding that they get a particular strategy bespoke for themselves. And so this manifests itself in a way that you might have in a traditional private equity fund, to step back, you have investors that are all the passive kind of money partners where they don't make any management decisions. They don't make any investments or other decisions on how the fund will go about its business. Instead, they just delegate all of those responsibilities to the fund sponsor or manager. But in these more bespoke co-investment joint venture arrangements, you might have an investor that participates in what's called a fund of one or a separately managed account, where the sole investor in that strategy is one of these larger institutions. And then by being the sole investor, they get a bit more leeway and flexibility in dictating what the strategies might be pursued. And they also get to perhaps opt in or opt out of particular deals. So again, it gives them a bit more tailoring of what exactly strategy will fit their purpose in their portfolio. And so that's a fund of one or a separately managed account. But then there's also co-investments, which instead of investing through a fund into a particular company, the investor will invest alongside of it. So again, they might get more direct exposure. They might have more discretion or management rights over a particular company strategy, which is all good. And they do it for several reasons that are listed on the slide, and you can look through them. But the main difference here is that when an investor branches out into this sort of investment strategy, they have to build out their own internal capabilities, because the amount of due diligence and research that's done by an investor into a company is a lot different than when they're picking a manager that they'll use to manage their investments for them, or a fund sponsor that they'll invest with. So with all of those changes, we're expecting to see, and Mark might talk about this in a moment, more diverse players in the private equity deal arena, where you have what used to be traditionally private equity players. It's now some of the investors directly going into those investments as well, which will change that landscape. But so those are the main trends and overview of what the market looked like in 2020. But with that, I'll pass it to Mark, who will talk about the deals and other private equity outlook.
Thanks very much. So I think sort of moving into the sort of the private equity transacting space down from the fund formation space, and to talk about some of the trends there. I think we can talk through what's been going on in terms of deal volume and everything else. But before we get to that, we thought it would be worth touching base on some of the items which have effectively created the trends that we're seeing, and which we saw over the last 12 months. So with the upheaval of the start of last year with COVID in particular, but also with issues around various kind of elections coming up, trade tensions and so on, we had a relatively unusual market dynamic. There was a friction between the amount of dry powder which funds have to invest versus what they would transact in and what they were willing to look at. And we had a sort of, at one point, a very sizable gulf in expectation between sell side expectations of value and what buyers were willing to pay against the backdrop of all of the uncertainty that was out there. Now, that manifested itself largely in a significant drop off globally over the early part of last year. It started in Asia and then moved to the US and Europe. And then by probably mid-year, everything began to come back online. It was somewhat sector specific, but funds started to deploy capital again, and the volume of transactions really picked up, notwithstanding the fact that you had a backdrop at that point of various elections going on. There was the Brexit issue in the UK, and there was general uncertainty globally of the sort of the 2 steps forward, 1 step back issues that COVID created. And so when we move into looking at the volumes, you're going to begin to see that in terms of the volume of transactions and where they came from. I think if we move on to the next slide, which is sort of going to deal with the volume of deal activity, you'll see that overall 2020 was similar to 2019, very much down on the levels of 2018 in terms of the deal value and the number of deals. Now, what's interesting, which isn't really shown by this slide, is that 2020 H2 was one of the busiest periods that I think we've ever seen for deal making globally. I would liken it to pulling an elastic band and then releasing the band. For the first 6 months of the year, with the backdrop of COVID, we had a number of, there were aborted processes, there were processes that weren't being launched, and so on. And then in H2, those deals which would have been done in the first half of the year came back, and then we layered on a whole bunch of additional deal making in the second half of the year. And that trend has really sort of pushed itself forward again in 2021. In the sort of the latter quarter of 2020 and into 2021, there was sort of record deal making in terms of SPAC structures and in certain sectors, which were incredibly resilient. We've not seen that trend progress across the board. Certain sectors are still struggling in terms of what I would call plain vanilla private equity, traditional private equity deal making and buyouts. Though there has been significant deal activity in terms of alternative financing arrangements, in terms of other kind of corporate rescues, etc., of companies which may have been suffering from distress because of the backdrop of COVID, so particularly leisure, travel, and hospitality. So I think when we move into looking at the sectors and what has been popular and why, we'll see that the largest volume and concentration of deal making has been in sort of IT and consumer discretionary. And when we talk about consumer discretionary spending at IT, there's significant overlap now. The activity that we have seen has been incredibly focused on things with an online presence, with the move away from things which are sort of very reliant on bricks and mortar and so on. So you've had IT being incredibly popular, consumer discretionary incredibly popular, industrials as well, and that is kind of coming to the kind of the use and consumption of products and so on. The interesting thing about all of the areas which have seen the highest deal activity is the fact that they are very, very concentrated on things which can be rolled out, to the home consumer and so on. And they're also very, very concentrated in terms of sort of particular areas where, in spite of COVID and with the backdrop of COVID, there's been significant growth. Now, the way that's manifested itself has been in record valuations, in terms of sort of tech assets in particular, but also in healthcare and others, where we've had significant growth, even with the backdrop of kind of inflating valuations. That trend will probably continue in the near term, and the expectation for that continuing in the near term is the fact that there's a lot of money to deploy, there's still a lot of cheap debt available, and the growth in these companies is still outstripping the rest of the market. Others are playing catch up. I think what's quite interesting is that there was probably a bit of a resurgence last year in sort of raw materials and natural resources, and people have begun to invest in those areas as a move away from inflationary pressures in certain other areas, and kind of a flight to those sorts of assets. We would expect that real estate and things like that are going to continue to lag for some time thereafter, particularly if you're looking at commercial real estate, the moves towards home working and so on have meant that, there's been a reduced demand for things like office space. And you have, additionally kind of other pressures on those sorts of investments as a result. If you're, for example, a real estate investor looking for rental yields, there's limited yield in the market. And so that's expected to, remain suppressed, at least into the near term. If we move on to the next slide, I just want to pick out a couple of trends that we've been seeing in the market. And I think this is very consistent with what Zach was talking about around diversification and the expectation from LPs and others around diversification and how PE funds achieve value. With the backdrop of record pricing on assets and so on, it is more difficult, I think, as a plain vanilla PE investor to come up with an acquisition, an asset which on a standalone basis is going to deliver outsized returns to investors. And there is ever more competition, as Zach mentioned, in those spaces. So whereas 20 years ago, you would have had a more limited pool of potential acquirers for any business, now we have family offices, sovereign wealth funds, private investors, VC investors, plain vanilla PE, alternative capital providers, all occupying to a degree the same sort of space. And what that means is valuations go up and the overall return expectations go down. Now, if you're a pension fund, if you're an insurer, if you're a sovereign wealth fund with a very long-term horizon, that may not be concerning. You don't have the same concern around overpaying because you're not looking to exit an investment in a short period of time profitably. You can afford to sit on something which has got a 6 or 8% annual yield without too much concern. But for a classic sort of PE structure, that would be on the low side. So as a result, what we've seen from PE is a real push into spaces where they are able to gain benefits, to gain synergies and so on, in order to achieve sort of better returns and better return profiles for their investors. And so the two that I want to highlight today are the carve-outs and the buy and build strategy. So a classic carve-out, you would have a corporate entity which either has a non-core division or another division which is not, or business line which is no longer sort of deemed to be the key focus of the business, which they'll look to divest from. And that sort of divestment is potentially attractive on the sell side if you're looking at, say, a corporate looking to do a carve out, because it allows you to deleverage. If you've got debt, it may create sort of earnings enhancement. It allows sort of the refocusing of the business onto a particular strategy and product line, which if you've got a backdrop of, say, an activist investor or somebody coming in trying to push for certain outcomes in the business, it can be a good way of sort of achieving aims for the corporate and allowing for the divestment of anything which is deemed non-core. Now, from a PE perspective, there's an attraction to a carve out insofar as because the business may not have been tested on a standalone basis. Pricing may be somewhat more attractive than if you were buying a standalone business. It can be a great, a carve out transaction can be a great toehold for a buy and build or a roll up strategy. And you can acquire, a business with some real long-term growth potential because it's not been given the attention that it may have deserved because it was deemed non-core by a corporate. And so we see this in the survey that's played out. We've got 60% of respondents saying that they're increasingly targeting carve-outs as a result. Now, the carve-out space hasn't become as busy or as occupied as certain other strategies, and that is somewhat due to the fact that they're quite difficult. it's harder to get a good handle on the business. It requires more diligence, attention. The financing aspects are potentially more difficult as you're testing EBITDA on a sort of, on an untested basis. And that means that PE, they'll look at these and they'll say, okay, we can target this, but it does require a lot of resource to be deployed into one of those transactions. And so whilst we see more people targeting them, we've not yet seen the increases in volume. We've seen it, the carve-out space being very much a space occupied by the large cap segment of the market thus far, and that's because the PE sponsors are more likely to have the expertise in-house, and also because the PE sponsors are much more likely to be able to acquire a very significant business. For example, say ThyssenKrupp's lifts business, that's an 19 billion euro transaction. There's not that many individuals or entities who would be able to afford an asset like that, and that means that the competition levels are lower. That will probably move down more into the mid-market, but as the competition increases, then we're going to see corporates having to almost kind of hive out ready for sale these assets in a way that they haven't been doing and haven't been particularly willing to do in the past. Then the other thing which I'll mention, which kind of ties into the carve-outs, because we do often see carve-outs as a toehold for this strategy, is the roll-up. There's been substantial increases in the number of sort of roll-up and platform acquisitions. This is a trend which has been increasing for the last 2 to 3 years and continues to pick up pace. And you'll see here, obviously 68% of GPs are using this strategy, and that will probably continue to increase. It means that, as a strategy, you've got a level of popularity to taking, potentially fragmented businesses which have not, individually occupied significant market share, and you put them together. And so, vets businesses, dentists, pharmacies, things like that, against a sort of relaxing regulatory backdrop, you've had opportunities where the roll-up can allow for real business growth. And now some of those early roll-up businesses are coming to exit. We're seeing some absolutely spectacular returns just by virtue of the strategy, which is likely to make it more popular. The reason that people like roll-ups as a strategy, they like platform acquisitions, is the whole idea of making, something which is greater than the sum of its parts. You can grab market share, you can centralize offering of certain higher margin business lines, you can bring synergy value by centralizing costs and so on. And that then, again, all facilitates the ability to enjoy a potentially enhanced return. And one of the things that we are seeing, which we're also seeing on the fund formation side, is more longer term hold funds, which are, rather than the classic sort of private equity 5+2 year model, are targeting sort of 15 to 20 year holds to facilitate add-on acquisitions of a particular cornerstone investment, often acquired from a carve-out, which can then be built upon for a lengthy period of time. There are challenges, of course, with any roll-up strategy, and this is something which may kind of reduce the popularity over time, though we're not seeing that as yet. Integration is more difficult. The more add-ons you're doing, the more you have to integrate. That brings with it challenges, that brings with it costs in the near term. It's difficult, of course, with any model like this to ensure consistency and quality. And then there are also, potential challenges with the businesses that you're adding on and how you might incentivize people within those businesses and so on. That may act as a handbrake over time, but as a strategy, it seems to be growing in popularity, and that's been borne out through Q1 2021. We'll expect it to continue to increase for the remainder of the year. I think now Sam's going to talk about the financing aspects of and trends that we're seeing in the market.
Great. Thanks, Mark and Zach. So private credit is an industry or a market that has really exploded over the last couple of decades. 20 years ago, the private credit market was worth about $40 billion. And today it's worth about $800 billion. So that's a 20 times increase in 20 years. I think there are a couple of factors that are driving that. There have certainly been compression in the bank lending market, given, leverage lending guidelines and the financial crisis, which has had certainly an impact on banks' willingness to lend at higher multiples. These direct lending funds have come in and really consumed that portion of the market that used to be filled by banks, or they've really created a market for financing companies that didn't get proper financing previously. There are a couple of different ways that we evaluate private credit, but direct lending is certainly the most popular. And over the last several years, most GPs have utilized direct lending in one way or another. So we see on the slide here that 88% of GPs reported that they have increased or kept pretty stable their use of private credit over the last 3 years, which really just indicates the normalization of the private credit product. During the pandemic last year, there was fairly limited disruption. It was fairly exaggerated over a short period of time, but much different than the financial crisis in 2008. This past year, we saw private credit funds bounce back and be willing to jump back into deal making with private equity funds. And in fact, terms, at least in the US, are quite a bit more favorable, or at least as favorable to sponsors and borrowers who are consumers of private credit than they were pre-pandemic. So the impact on the private credit market has been relatively modest, particularly in light of the impact on various other sectors of the economy. Most multi-strategy PE houses these days insist on having access to private credit. And in a lot of cases, they have opened up a private credit fund to sit alongside their private equity fund. Couple of things driving that. Certainly, it creates an opportunity to offer a more diversified product and to control and increase the assets under management without becoming overly concentrated in one particular offering. They're also pretty good yield on private credit loans. So direct lending funds will bring in, they source a pretty good fee stream for the aggregate fund, and that helps boost returns for the GP and the other investors. A couple of reasons why private credit has become so popular, in addition to where it comes from. Certainly, private credit funds will offer better terms in a lot of cases. They offer more flexibility. They offer higher leverage ratios. They also offer ease of execution. 60% of the respondents in this survey indicated that ease of execution and greater flexibility on terms was the greatest advantage. In my personal experience, I have seen private credit funds and direct lenders offer better terms generally and are more responsive to what a private equity investor is looking to do. So as Mark was saying about the buy and build strategy, which is becoming more and more prevalent, we've seen over the last several years that private credit funds are really willing to take on that risk with a private equity investor to grow the business. And they're willing to offer delayed draw term loan facilities and other sources of additional capital and additional liquidity down the road to support the PE investors' investment thesis, which has been great in terms of forming relationships, but it also creates reliability of financing sources. And I think that PE funds, particularly in the middle market, appreciate knowing that they can go back to the same well several times as opposed to trying to dig a new one. So that's been a real source of comfort in supporting a buy and build strategy by our PE clients in particular. Of course, there is a trade-off for all of this: the greater flexibility, ease of execution, access to additional capital, real relationship forming. It all comes at a higher cost of capital. Generally, a private debt fund is not going to offer the super low interest rates that a bank will offer. And you'll see that there will be a general, maybe a 2% difference between what you would get, 2 to 3% difference between what you would get from a bank versus what you would get from a direct lending fund. And so some PE investors don't want to pay that additional yield, or they don't want to increase their overall cost of capital on a deal. But what we have seen is that in most cases, the greater flexibility and that relationship, the reliability of the relationship and the additional sources of capital will generally outweigh whatever modest increase in pricing is put on a debt instrument. About half of GPs are using equal amounts of private credit and bank financing, which I think is just incredible that, in 20 years, we have displaced half of the bank financing market. It's really impressive, and it shows the flexibility and durability of the private credit product. Again, through the pandemic last year, I think that there was a lot of concern that private credit funds were not going to be able to support all the portfolio companies that were in their investment package at that point in time, and that just didn't end up being the case. I think there were certainly some private credit funds that struggled a little bit to support their companies, but for the most part, banks and private credit funds survived in terms of offering capital and supporting their portfolio companies and managing amendments and waivers and covenant relief and the like during the pandemic. The banks and private credit funds manage those just as well. So I think we've sort of seen the first test of private credit funds surviving a downturn or a market disruption, and they came out with flying colors. So I think we'll only see more use of private credit versus bank financing for particularly middle market companies going forward. Just a couple of words to piggyback on what Mark was saying about the buy and build strategy, which is something that in the financing space certainly is an attractive avenue to go down and present some interesting challenges. For the most part, these deals are a little bit smaller, we have seen, and they have good leverage profiles on them from the beginning. So it's a little bit easier to tuck them in and fit them within an existing credit structure. Certainly lowers the execution cost, and it lowers the risk of investing into a brand new platform business by building it out with proven companies at a lower multiple. There's certainly a greater return on exit. You can juice those returns. And a lot of our clients are pursuing that. On the financing aspects of it, private credit funds really like a roll-up strategy when they're offering a debt package. They like knowing that there's a little bit less diligence to do, that they have, in most cases, worked with the management team for a little while, and they can be a little bit more comfortable with the way that an add-on is going to be integrated. In most cases, we have seen private credit fund lenders be very, very supportive of a roll-up strategy as a low-risk way to put to work additional capital. Most of these investments are heavily funded with financing, if not exclusively funded with financing, and it makes for a really attractive way for private credit funds to deploy capital and get those returns with much lower risk than financing a platform investment in the first case. I think that's all we wanted to cover on private credit today, so we're going to move to questions.
I'll just stop sharing my screen, and everyone can bring on their video. All right. So as we wait for everyone to sort of turn on their videos and join us, to begin with, I think, Zach, I have a question for you regarding, you mentioned that aggregate raise is up, or I mean, not as well as it was in 2018, but up in comparison to years past. And my question there is, obviously, we've seen public markets make one of the fastest and most volatile recoveries that I've ever seen. So the question is there something that we're missing here? Is there a lag? Is there a bottleneck in this process that that is limiting? I mean, obviously, private markets tend to lag behind public markets historically, but is there something that we're missing in this problem?
No, I think that's exactly right. It's a good question. And as investors, especially say pension investors or U.S. state pension plans kind of look at what their overall portfolios are doing in March, April, May, and June, a lot of those types of investors put their investments into private equity on hold. So there was a relative pause. So I think that's the primary leg that we're seeing in 2020 on the fund formation market. A lot of those funds that were put on pause have since continued and picked back up and are having closings. And so I think the fundraising in 2021 and beyond is going to be match, if not exceed pre-pandemic levels. It's just a matter of these, funds sometimes take a matter of, 3-6 months or something to diligence, have the investors do the due diligence on the sponsors. And so there's just a lag in the market. And that significant pause did really impact it. But as Mark indicated on the deal side, the second half of 2020 picked right back up. And I think we're seeing it in 2021 as well. And it'll likely continue for the rest of the year and beyond.
Sure. And with regards to Mark, I know you had a bit of overlap with Zach in regards to the buy and build strategies. Obviously, I find buy and build strategies very interesting. If you could describe a little bit more in a bit more detailed way what buy and build strategies are, because I suspect a number of the students that might be watching wouldn't know, and I think it might be useful to know, particularly given that these are more prolific moving forward.
Yeah, absolutely. So I think the sort of the buy and build strategy is classically where you find a business in a particular sector and you add other businesses, either complementary businesses or businesses doing exactly the same thing, onto that business. And so if we take a great example, one of my personal favorites is a business called WaterLogic. WaterLogic, we make effectively kind of in-office water taps for kitchens. And they also have a business which does kind of your classic kind of water coolers. Now that started out as an acquisition of a single business called WaterLogic, and then they added subsequently a number of other businesses to that over time, and I think have now done something like 50 or more add-ons in different geographies of businesses which are providing kind of point of use water for offices, for domestic use, and otherwise. And so rather than seeking to just grow the business organically and to sell more product into target markets, you're buying a level of customer volume in complementary products and then rolling it out under the same branding. And we've seen it deployed very successfully with other businesses which are perhaps kind of almost better known but very fragmented. And so dentists, pharmacies, veterinary businesses, where historically the model was a sort of a small either sort of single practice business or kind of 4 or 5 sites, but not very much more than that. And then those sites can be acquired under one strategy. Either you either start with one single investment and add to it, or you just start to put these things together. And the benefit to the strategy, the potential benefit to the strategy, is as you acquire these businesses, all of those businesses will have their own individual functions to deal with things like IT, to deal with things like payroll, to deal with things like ordering and so on, very, very fragmented. That can all be brought under one roof, effectively centralized. And that brings with it economies of scale and cost savings. And it also brings with it the ability to sell complementary products to a much wider base of customers. And so as a strategy, it can be very, very attractive, provided you have enough time to deploy the strategy. The reason we've seen the longer term hold funds coming into the space is because there's only so many add-ons that you can buy and integrate in a particular period of time. And so almost the longer you have, the longer you have to acquire and to smooth the integration process in order to allow you to maximize the value of the business.
It's very interesting. So could we potentially, does that potentially mean that in regions like, for example, Southeast Asia, where we're seeing platform banks and digital super app players that are looking to build their ecosystem or platform by adding individual companies, that does this mean that we're expected to see even more upward pressure on valuations because of this crowding out, or is this strategy just one of the many?
I think there'll be a level of upward pressure on valuation. The interesting thing that we've seen with the way that buy and build has progressed in the past is that the competition for the initial cornerstone asset has continued to increase. And so the value of the business, which is large enough to make it interesting as an initial business, has never been more competitive. It's never been, the valuations of those businesses are at a record level. The add-on opportunities, depending on size, are there. Whilst there will be some upward pressure as you get more entrants into the market, effectively that's always lagged behind. There's a level of kind of multiple arbitrage in terms of what a buyer would have to pay for a small add-on asset versus what they would have to pay for the initial cornerstone asset. Again, that can be helpful in terms of sort of adding to returns and enhancing that. However, I mean, you have to look at all of these things. Every market participant sees a successful strategy and will follow that successful strategy in time. There are certain barriers to entry to effective roll-up strategies in the same way as there are for effective carve-out strategies. And that will mean that there's probably always going to be fewer people operating in the space than in the straight sort of investment and buyout market. But I think there are opportunities there. We'll see upward pressure on valuations. Eventually, if that moved up far enough, you'd see the success of the strategy begin to reduce. But we're not there yet by any stretch.
Sure. I'll open up for questions to anyone else that might have any. I know I have a few more in mind.
Hi, can you hear me?
Yep.
Hi, yeah. Thank you so much for your presentation. It was really insightful. I wanted to ask a question about more of the covenants that you guys are seeing that are tied with, the contracts and also the credit and whatnot. So the LPs in general, the market is shifting towards, more of an ESG narrative, and we can see a lot of the GPs, they kind of are trying to do a little bit more in their impact investments and whatnot. But from a covenant point of view and, setting up these credits for the LPs, how are you seeing, the industry has changed in terms of, what people are requesting to put into their contracts and to put into their financing agreements? And yeah, could you guys share a little bit about, what you guys see are trends?
I'm happy to jump in quickly on, at least on the fund space. So when negotiating with between fund sponsors and the private equity investors, a lot of the institutional investors do require some sort of covenant that when the sponsor makes an investment, they'll consider ESG, environmental, social, and governance matters with respect to those companies that they acquire, and even go so far as to say that they'll use some sort of efforts to get those companies themselves to implement some ESG and social good principles. At the fund level, at least in the past few years, it's been very soft covenants. So we understand that you have an interest in it and we'll seek to implement those, but there's nothing hard, there's no guarantees, there's no absolutes in this space so far. unless you have a fund that is really exclusively having its strategy be one of these impact investment style funds, it's more an acknowledgement. And a lot of the funds that invest in, say, tech companies, which Mark mentioned are very popular investments at the moment, it's a lot easier to put in a environmental covenant or say an environmental principle for those types of companies, because of course, they're not burning a lot of coal or doing anything else that's harming the environment, because tech companies are mostly paperless or other things like that. So the soft standards are what we're seeing, and they're somewhat easily complied with, at least on the fund formation side. I'm happy to kick it to Sam or Mark on anything else that you might have to add on the financing or deal side.
Yeah, so on the deal side, what I would say is it is becoming progressively more important to sponsors, and the level of focus on it at investment committee level on ESG matters and on governance matters, on anything anti-bribery and corruption, etc., is just growing year on year on year. I think there's much more of a focus now of the fact that reputational harm can come from not paying enough attention to these areas. Now, there are certain sectors, as Zach says, there's certain investments where, certainly from an ESG perspective, it will never be a green business, it will never be a clean business. But we do have investors looking a lot more at mitigants, and if those are the spaces that they want to be in. I think the co-investors in particular are becoming a lot more active in terms of the requirements that they impose on particular investments. It's very geographically diverse in terms of which sorts of investors have particular focus on areas such as ESG, on compliance and so on. But it is just as a trend, the market move seems to be much more focused on things that, even though there's not an absolute requirement for the fund to be focusing on these things, they are focusing on these things, and looking forward, they see the benefit to actually having a lot more focus on whether or not the investments they're making are sort of not just ESG compliant, but also are kind of positive investments from an ESG standpoint.
Sorry, I just wanted to jump in with a couple of words on the financing aspects of this. I think I agree with what Zach and Mark just said, and I think that it is even more distilled in the financing context. So we're not seeing really any covenants make their way into documentation that require companies to try to do anything, frankly. But it comes up in diligence from time to time, and lenders are insisting a little bit more on, or if they're digging in a little bit deeper on some of these issues and trying to understand what the company's existing policies and practices are. It comes up quite a bit when you're talking about a more syndicated deal, or a deal that has multiple lenders that are buying smaller pieces of the debt. So it's not one lender coming in and doing all of the diligence, it's multiple lenders coming in, and each of them is doing their own bit of diligence. This is one topic that has become increasingly prevalent in the diligence process and approached from multiple different angles, but we haven't yet seen it make its way actually into the definitive debt documentation yet, although it seems like that's probably where things are going, something along the lines of what Zach was talking about, of a commercially reasonable effort standard to establish certain policies and procedures within a specific amount of time, so that there's not hard pressure on a company, but that everybody understands that we're all going to try real hard to make sure that we're bringing our practices and policies into line with what lenders and other investors expect.
This transitions perfectly to one of my key questions, is that when it comes to ESG funds or ESG matters, I think it's on the top of everyone's mind. But given that a lot of the push for ESG seems to be, at least recently, market driven, and at least from the investor driven, and from their own interests and from differences between different investors. The question here is, how much is the regulatory environment, how much has it influenced what it looks like today in terms of ESG related awareness, and how much is it going to influence it in the future? I mean, I know there are things like the EU taxonomy, which will require businesses to report that kind of information even more moving forward. But there's a question whether this is being driven by just investors' choices, or is it something that we're going to see a framework around that is going to be more standardized?
I think just looking at the kind of the investment goal and what the funds are focused on now is avoiding very much the existential business, whether it's in a polluting industry or it's plastics or something else. It's not necessarily looked at anymore in the short term, as in, can I buy this business, profitably grow it, and then sell it? It's, if I buy this business and profitably grow it, will there actually be a buyer there, or will regulation have changed so much that if we haven't pivoted completely on business line, then we will have no buyer for the business and it will end up disappearing? And so, you see that on the corporate level with the oil majors moving into green technologies, moving into carbon capture and storage and so on, because the business has to pivot. And I think now, looking at the regulatory framework, is the focus is not just on the regulatory framework as it is. It's not even on regulatory framework impending changes. It's on, in 10 years time, in 15 years time, where is everything going to be? And therefore, should we be investing in this business against that backdrop? And looking for, it's difficult with the sort of the green investments, with the impact investments. At the moment, a lot of the technologies and a lot of the sectors are in their infancy, and so picking the right investments is somewhat more tricky than it would be if you were buying a mature business. But trying to find the right assets to back the new thing is becoming much more important as a focus. And I think that's going to continue. There's regard paid to current regulation such as it is, but there's much more regard paid in our diligence now as to what is likely to change in the future. What is the regulatory backdrop going to be in 5 or 10 years time?
Sure, thank you. That definitely answers my question. So just as we wrap up, and I know I'm quite conscious of time, I do have one final question. A number of second-year students at the LSE, members of our society, including those on our exco here today, are entering internships this summer. Some of them are going into investment banking, some in private equity, many in other fields. They're going to be preparing for market awareness and readiness over the coming weeks. What sort of advice or what takeaways do you have for them that they should pay particular attention to, or study up on, or read about, that will prepare them well for this summer from your perspective?
So I can jump in on that, and then Zach, feel free to add. I mean, I think in kind of line with the themes that we've been discussing here, I would be most interested in the changes that we're seeing in traditional markets and traditional industries and what's driving those. And so, why are investors looking at new areas? Why are certain other traditional areas becoming less attractive, and what's that doing, and is that trend likely to continue? I think I would very much be looking at what's the interesting niche, what's the growth area, why is the world changing in the way that it's changing, and the world of deal making changing as a result. And I think following macro trends is very interesting, because you can almost begin to pick up trends which may take place in one geography, which may then manifest themselves in another and not yet have done so. And so, anything around that is probably a key focus area. I mean, the fundamentals of transactions and deal making hasn't changed. And I mean, what we do in terms of the fund formation, in terms of the M&A, in terms of the financing, the bones of that never really change. There are always developments, but actually what investors are looking for, what sits behind that, is changing at incredible speed in this environment in a way that we haven't seen over the last 20 years. And the drivers behind that would be an area where I think you find some sort of very interesting facts and some very interesting kind of outlooks, which you can then sort of begin to study further going forward.
I would say that I think one of the things to keep in mind is that you can certainly read a lot in the paper, and there are articles and blogs and webinars like this that have lots of prognostications about what the market's going to look like and where everything is going. But to remember that having conversations with other people who are similarly situated, people who have more experience, less experience, different experience, will really always be your best resource. And so I think engaging in those conversations, whether it's live or virtually, and trying to suss out trends that are, underneath conversations, and trying to figure out how others see market trends and where they think things are going and why, and where we've been and why. And like Mark said, how different, the bones are sort of the same, but how different trends emerge and why at certain points in time. And I think that in my experience, at least, I've always gotten the most out of those interpersonal conversations where you can really ask those questions and probe those thoughts. And that's always helped me understand the macro trends a little bit better, and also helps me see things that I didn't see before in where the market is going and where it's been. So, keep your ears open and talk to your friends.
Sure, definitely. Zach, unless you have anything to add, I think I'm ready to. Yeah. Okay, so I want to thank everyone from Dechert, particularly for your sponsorship and for your continued belief in Alternative Investment Conference. We have a great lineup this year of videos that a number of which are public. They're on YouTube. Some are for LSE students only. Please do check it out on our website, www.lseaic.com. This video was sponsored by Dechert, and we look forward to having these speakers as well as other members from law firms and from private equity firms on campus in the coming year ahead. Thank you.